Would you like to know about a cheap stock that still hasn't recovered from last year's crash? Like the idea of collecting big, safe, growing, passive dividend income? Want a yield that's more than 4 times higher than what the market offers? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a critical energy infrastructure company moving oil and gas to where it needs to go. While the world is trying to slowly move toward renewable energy, the truth is we still need hydrocarbons. Our modern day society really can't function without products like oil and gas. And this company runs incredibly valuable and important pipelines that ensure that those energy products get to where they need to be. In doing so, they collect fees, a lot of fees, and those fees translate to growing profits and dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Enbridge Inc, which appear to be trading at a significant discount today. Enbridge Inc, stock ticker ENB, is an energy distribution and transportation company that owns and operates crude and natural gas pipelines across the United States and Canada. It also operates a gas utility business. Additionally, the company has considerable exposure to renewable energy through a diversified portfolio of renewable energy projects. Founded in 1949, Enbridge is now a $78 billion by market cap energy powerhouse that employs more than 11,000 people. The company has 5 business segments: energy services, 47% of fiscal year 2020 revenue, liquids pipelines, 27%, gas transmission and midstream, 13%, gas distribution 12%, and renewable power distribution 2%. After merging with Spectra Energy Corp in 2017, Enbridge has now become the largest energy infrastructure company in North America. Enbridge operates the world's longest and most complex crude oil and liquids transportation system. To give you some perspective, their pipeline network stretches from Norman Wells, Canada to Brownsville, Texas. They operate over 17,000 miles of active crude pipeline across North America, split almost evenly between the US and Canada. The company transports 25% of the crude oil produced in North America, and they also transport 20% of all natural gas consumed in the US. This is a massive and indispensable energy infrastructure company. In addition to this energy infrastructure, Enbridge is Canada's largest natural gas utility. The company serves approximately 3.8 million retail customers in Ontario and Quebec. To cap it all off, they're working hard to future-proof the business. Enbridge aims to have net zero emissions by 2050. They've committed almost $8 billion to renewable energy and power transmission projects that are currently in operation or under construction. Some of their low carbon opportunities include renewable natural gas and hydrogen power to gas. While the world is starting to wean itself off of hydrocarbons, our modern day society currently cannot function without these energy products, and there's no immediate future in which that reality is all that different. Moreover, Enbridge has impressively insulated itself from volatile commodity pricing. The company estimates that approximately 98% of its cash flow is predictable through regulated operations, take-or-pay contracts, or fixed fees. Put all this together, it's not hard to see how Enbridge has managed to consistently keep its profit and dividend flowing and growing. As it stands, Enbridge has increased its dividend for 25 consecutive years. If that's not impressive enough, the 10-year dividend growth rate is 11.3%. But wait, there's more. That rather high dividend growth rate comes on top of the stock's current yield of 7.3%. This yield is more than 4 times higher than the broader market's yield. It's also 160 basis points higher than the stock's own 5-year average yield. It's not often that you'll find a yield this high paired with a double-digit dividend growth rate. Now, I wouldn't expect that kind of dividend growth to continue indefinitely, but an investor doesn't need a high growth rate when the yield is over 7%. Nonetheless, the dividend appears to be safe and in a position to grow in line with the business. That's evidenced by the elevated but unhazardous 68.9% payout ratio. Looking at business growth, Enbridge grew its revenue from $19.402 billion Canadian in fiscal year 2011 to $39.087 billion Canadian in fiscal year 2020. That's a compound annual growth rate of 8.09%. Great revenue growth. While that vastly exceeds my expectations for a pipeline company, it's important to keep in mind that much of the top line growth was fueled by the 2017 acquisition of Spectra Energy. And since this acquisition fundamentally changed the business, I'll be showing bottom line growth from fiscal year 2017 onward. However, in this case, I won't be looking at earnings per share. Being an infrastructure business with a large midstream presence, it translates its profits like an MLP would, as distributable cash flow per share instead of earnings per share like a normal corporation would. Enbridge grew its DCF per share from $3.68 Canadian in fiscal year 2017 to $4.67 Canadian in fiscal year 2020, which is a compound annual growth rate of 8.27%. This is a very strong result, and that's even after factoring in the turmoil that the pandemic brought to energy markets during 2020. I think this shows just how resilient the business model really is. Looking forward, CFRA projects that Enbridge will compound its earnings per share at a 15% annual rate over the next 3 years. I'm not sure if CFRA is translating the profit reporting from earnings per share to DCF per share here, but I do see that as an awfully aggressive near-term profit growth forecast. With energy under the regulatory microscope, the pandemic still not over, and Enbridge embroiled in a protracted legal battle over its Line 5, 15% annual growth is a high mark to reach. However, I think shareholders would gladly settle for something more in line with the bottom line compound annual growth rate the company has produced since taking over Spectra in 2017. For further perspective on this, Enbridge is guiding for $4.85 Canadian in DCF per share at the midpoint for this fiscal year. While that shows a safe dividend, it would represent only 3.9% year-over-year growth in DCF per share. I tend to err on the side of caution, and I think Enbridge is capable of doing mid-single-digit bottom-line growth over the near term, which would allow for dividend growth. In my view, that's more than acceptable when shareholders are also lapping up a 7% plus yield. Moving over to the balance sheet, the company is in good financial position. The long-term debt-to-equity ratio is 1.02. Enbridge has lowered its consolidated debt to EBITDA ratio from approximately 6 in 2016 to within a range of between 4.5 and 5. Their credit ratings are in investment grade territory. Standard & Poor's rates their senior unsecured debt at BBB+, Moody's Baa2, Fitch BBB+. Profitability is difficult to gauge. That's because of the way profit is translated. GAAP numbers can be misleading or even meaningless. With that said, over the last 5 years, the firm has averaged annual net margin of 6.53% and annual return on equity of 6.99%. Within the energy space, this is one of my favorite names. It has the kind of operational resiliency and dividend reliability that I love to see. And with a pipeline system that has incredible scale and integration, which would be nigh impossible to replicate by a new competitor, especially with regulation making it increasingly difficult to build new pipelines, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Whereas Enbridge does not have many formidable competitors, regulation and litigation are huge issues in their industry. Their current dispute with Michigan over their Line 5 is a prime example of that. In addition, it's becoming increasingly difficult for companies to get permits to build new pipelines, making the existing infrastructure that much more valuable. While scale is a key advantage, it also works against them in some ways. There's less growth potential with a mature business such as this. Even though the company is largely insulated from volatile commodity pricing, they remain sensitive to energy over the long run via demand and counterparty risk. There's long-term business model risk as society is starting to move away from hydrocarbons. Enbridge has invested in renewables, but the core business model remains based on hydrocarbon consumption. Their balance sheet is good, but plenty of debt is on the balance sheet. Any increase in costs as it relates to raising capital via equity or debt would harm the company's growth plans. Overall, I view Enbridge as a great idea for dividend growth investors looking for yield and who are okay with the risks. That view is amplified by the fact that the the stock has not yet recovered its pre-pandemic highs, leading to an attractive valuation. The stock is available for a forward price to DCF ratio of 9.5 based on the midpoint guidance for this year. With this being analogous to a PE ratio on a normal stock, it's obscenely cheap when compared to the broader market. However, this is a stock that's always cheap. I think the market has taken a prudent approach considering the risks, and that's fair. Looking at it from another angle, the price to cash flow ratio of 9.7 is not far off from its own 5-year average. On the other hand, the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate to account for the high yield and a long-term dividend growth rate of 3%. That dividend growth rate looks downright disappointing when you compare it to the 10-year dividend growth rate. In addition, the recent per-share cash flow growth has been stellar. However, again, I'd rather err on the side of caution. The payout ratio is elevated, and the midpoint guidance for this fiscal year shows less than 4% year-over-year growth in per-share cash flow. In addition, the regulatory and legal risks here are high. The dividend discount model analysis gives me a fair value of $56.86. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Enbridge as a 4-star stock with a fair value estimate of $46. CFRA rates Enbridge as a 4-star buy with a 12-month target price of $45. I came out high, surprisingly. Averaging the three numbers out gives us a final valuation of $49.29, which would indicate the stock is possibly 30% undervalued. Here's the bottom line, guys. Enbridge Inc. is a world-class infrastructure company. They have little exposure to volatile commodity pricing, and they've operated through the pandemic admirably, with a market-smashing 7% plus yield, double-digit dividend growth, 25 consecutive years of dividend raises, and the potential that shares are 30% undervalued. This is a great high-yield opportunity for long-term dividend growth investors willing to accept the risks. And now for a special news announcement. Home Depot Inc., stock ticker HD, just reported a stellar first quarter. Revenue was up more than 30% year over year. Comps were up an amazing 31%, and earnings per share increased by 85.6% year over year. We put out a video back in March highlighting the opportunity in Home Depot shares when they were still around $250 a share. This remains one of the very best retailers out there.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.